All right, so we are back at Outlier University today. Let me introduce myself real quick. My name is Christopher Ewell. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk together as a team. So go ahead and subscribe if you haven't already. Now, I was actually listening to Market Wizards. I don't know if you guys have had a chance to read those books yet, but Larry Height, one of the Market Wizards I worked with, he's featured in the original Market Wizards. And I was listening to that while we were driving around the other day, and it was great to hear Larry back in his prime, right? Like 40 years ago. Dude's like 703 at this point, older than Moses. And he was talking about, even back then, how important options were. Now, the strategy that I learned, doing the deep in the money options, capturing as little extrinsic value as possible, working in that direction, was exactly what I learned from Larry. He figured that out literally in the 80s. So it's really cool to see something that is that timeless still applies today and is still very profitable today. So looks like we lost Mike, but that's all right. Hopefully he'll come back. This is going to be Options Trading Basics Lesson 10. So before we jump into options, let's recap. What is a stock? The stock is a fractional ownership of a company, right? They are bought on the broker platforms at the stated price on that platform. So you can say, what is Apple's stock price today? And it'll give you a number, if it's $100, if it's $500, whatever the case is, it'll tell you what the price of that fractional company ownership is. Now we can take this a step further. This is a derivative. An option is a financial security based on the underlying stock, right? You cannot have an option without a stock. They have to go together. And that's why I say it is a derivative. It is a financial instrument based on the underlying stock. Lots of stocks have options, but not all of them, right? You come across stocks all the time that they don't have any options. And it is 100% fine if you never, ever, ever trade an option. There is nothing wrong with that. These are just a way to help you improve your portfolio once you understand how to use them. But if you say, you know what, options aren't for me, they're too complicated, that's totally fine, and I get it. Don't stress on that. Now, what is an option? An option is a contract between two parties. Like, for example, I could buy an option and Joe could sell me the option, right? It gives me, the buyer, the right, but not the obligation to purchase shares at a predetermined price by a predetermined date. This is going to get really deep. I apologize ahead of time. I'm going to try and make this as simple as possible, right? So whenever Joe sells that to me, I'm basically saying, hey, I want to buy the stock at this price by this date, right? And just to simplify it, I want to buy this stock at this price by this date, okay? And that price is called the strike price, and that date is called the expiration date. So I want to buy this stock at this strike price on this date. Everybody following? Or buy this date. It's any time between now and that date. That date is the last date of it. Now, why trade options? They can significantly return higher than stock moves. And it costs significantly less than buying the stock outright. And you can make money with it. You can profit if the trade is going up, or if the stock is going up, or if the stock is going down. You can structure it in a way to profit from either direction. I know I've told this story before, but I'd like to share it again here because it is the right time to do so. When I got excited about trading options, I was in corporate finance, and my boss at the time was having a conversation with one of my coworkers, and they were talking about Deutsche Bank. And he said, if you're so sure that Deutsche Bank is going to go down, why don't you go out and buy puts on it? And so, like, I went to business school and got an MBA, and I was like, wait a minute, puts, man, I hadn't heard that in 10 years. So I Google how to make money, trading options. And of course, it's, a put goes up in value as the price goes down. A call goes up in value as the price of the stock goes up. I was like, okay, cool. So then I went down the rabbit hole for years learning how to sell options. And we will not be covering how to sell options. If you want to learn how to sell options, there's a lot of YouTube scammers out there that'd be glad to take your money. I'm not one of them. I want to teach you the right way to trade, and it does not involve selling options whatsoever. And I went down that route for years, and I lost money with an 84% win rate. I was still losing money year after year after year. And so that was when I started working with Steve Burns and started connecting with Market Wizards. And it's like, listen, you guys have figured out how to do it. What am I doing wrong? I'll never forget Steve. We had this conversation. Steve Burns, I was explaining to him what I did, and he goes, oh yeah, Chris, I used to trade that way too until I realized I wanted to make money. I was like, all right, Steve, You got me. You totally nailed me on that one, right? 84% win rates, yet I'm still losing money hand over fist. Clearly, I'm doing something wrong. But there is a right way to trade options. We will be discussing that. There's also a lot of scammers out there, like I mentioned earlier, that'll love to take your money hand over fist all day, every day. This is not the place for that. But what is an option, right? What is an option? There are only two types of options. There's call options and put options, okay? So a call option increases in value as the price of the stock goes up. So this little chart down here, it's representing a call option. It is increasing in value as the price of the stock goes up. A put option increases in value as the price of the stock goes down. Okay, that is it. In a nutshell, options is exactly this. Call options increase in value as the price goes up. Put options increase in value as the price goes down. Okay, that is the majority of what you're going to need to know. Now, there's all these little intricacies that go along with it, right? Like everything good in life, right? There's like Dave is a pistol shooter, right, Dave? Right. I mean, in a nutshell, you're pointing at the target and you're pulling the trigger, right? There you go. That's all you got to know. Point at the target, pull the trigger. Right. And so people take that and they're like, oh, that's how you trade. Easy. Right. Dave will tell you, I'm sure there's significant amounts of complexity to do that at a high level. And if you want to be successful in the stock market, where it's the smartest people in the world doing everything they possibly can to make as much money as they can, which includes coming out of your account, you need to know all the intricacies on how to do this correctly. So let's go to the next thing. What is an option? I think of options like a coupon. Like at the end of the day, the way that I think of an option is like a coupon. I can buy a coupon, or I can buy a coupon to buy a stock or short sell a stock at a certain price. So like we mentioned earlier, Joe selling me the coupon. Joe's like, dude, Chris, if you want to buy the stock at $100, here's a coupon to do so. Cool, thanks, Joe. Right? Like every coupon out there, like when you go to Chick-fil-A or when you go to Sonic or any other place, all those coupons have an expiration date. So it's saying, hey, you can buy a Sonic double or whatever they call it. No, In-N-Out. You can buy an In-N-Out double for 99 cents, but you have to do it by July 1st. Right? We can conceptualize it in that way, right? I want to buy a double for 99 cents, but I have until July 1st to do so. That is my coupon. That is exactly the same as an options contract. You can buy your stock for, let's say, 99 cents, and you can do so by July 1st. Do we see how a coupon and a contract really are the same thing here? Okay, cool. Because when you think about it in that terms, it really makes sense to me. So what is short selling? I mentioned that just a moment ago. I don't want to get too deep into that, but because I mentioned it, let's discuss it. Short selling is betting that a stock will go down. Most of the time, we talk about stocks going up in price. We're going to buy the stock, it's going to go up. What is short selling? It's the opposite, right? We're selling a stock short, wanting it to go down in price. You borrow. Listen, this is going to get real deep finance theory. Don't worry if you don't understand it right now. We'll just explain on a high level. You borrow shares of a stock from someone else through your broker, right? It's not going to seem like anything else other than it's basically the opposite of buying. Okay, when you are doing the transaction, it feels like the opposite of buying, but here's the back end of it. You're borrowing shares from someone else through your broker. You sell them right away at the current price. Later, if the stock goes down, you buy the shares back cheaper, and you return the borrowed shares and keep the difference as profit. Like I say, deep finance theory. Don't stress on it. It's just it's the sell button instead of the buy button when you're in your broker platform. Okay, don't overcomplicate it. That's the way I think about it. And it sounds complicated, but it really just looks like the inverse transaction of buying shares when you do it. So what is an option? Going back to that, think of options like a coupon. I can buy a coupon to buy or sell short a stock at a certain price, and that coupon has value. So Joe sold me the 99-cent double coupon, but you know what? Doubles are going for $5. And Joe's like, listen, Chris, if you want this coupon, pay me 50 cents. You can then go buy your double for 99 cents. And even though you paid me 50 cents, you're still saving a buttload of money, right? Because, you know, it's $5 minus $1.50. It's $3.50 less than you would have had otherwise, right? Well, I mean, if you don't want to save $3.50 overall, then I'll keep my coupon. But if you want to take advantage of that, go for it, right? So that coupon has value. Even a double coupon has value, just like a coupon or a option contract would. So we are trading based on the value of that coupon going up or down. So for example, if I want to buy the double for 99 cents and the price of doubles goes from $5 down to $2, well, that coupon's not as valuable anymore, is it? Right? That coupon where I could get my double for 99 cents, Joe used to be able to sell it for 50 cents to me. But I can't do that anymore. I'm looking at like, I don't know about that, Joe. It's not worth that much money to me. Maybe you could sell it to me for 10 cents. Right? So that market price of the double had impacted the market price of the coupon. Look at this. We're getting really deep and we're talking cheeseburgers over here, okay? Now, you could convert that to shares at some point in the future, but I've never done this. Never once whatsoever have I actually taken delivery of shares. And so you don't ever have to stress on that. You can if you'd like to. You have the right, but you don't have the obligation to do so. So consider it like trading coupons here.
Mm-hmm.
Now, it's a contract between two parties, like I mentioned earlier. It gives the buyer the right, but not the obligation to purchase the shares at a predetermined price, the strike price, by the predetermined date, the expiration date. Is this starting to make sense? Are we starting to click on what the basics of an option is? Give me a thumbs up if you understand.
Mm-hmm.
Cool. In the chat, give me a number 2 if you're understanding.
Hey, Chris, we've got a really good question in chat right now.
What you got?
It's from James Michael, and he's saying, question, do options move the stock price? Which I think is a good one to point out.
Dude, you had this. That's more of an advanced trading question here, but let's go through it, right? Dave pointed out to me the other day when we were buying some stocks how we had an outlier effect, right? Not intentional, but enough people are actually paying attention now, thanks to YouTube. Enough people are actually paying attention now where when I put on trades, thousands and thousands of contracts are being put on in addition to my contracts. And so we actually can move a stock by doing so. So the question is, how does that work? If I am buying options, somebody's selling those to me, more than likely a market maker, because there has to be liquidity in the markets, okay? I may not buy them from Joe directly, but let's say that Mikey Mike is the market maker. Between these two guys, do that and this. Between these two guys here, I can buy all the contracts I want, right? I'm going to buy them from Joe, and I'm going to buy the rest from Mike. Now, when I do that, Joe's just doing his thing, but Mike down there, he's like, I just sold 1,000 contracts to Chris. I have a lot of exposure right here. I'm speaking as if I'm Mike. I now have to go out and buy, if I bought 1,000 contracts, I needed to go out and buy 100,000 shares of that stock to cover the contracts that I just sold to Chris. What happens if people buy more stock? It's going to push the price up. Exactly. So by buying options, we are indirectly causing the price of the stock to go up. Okay. Because the market maker, he's not going to leave his backside exposed. He has to make sure he has enough stock to cover what he just sold to me. So pretty cool, right? Steven added a point. Market makers hedge by buying or selling the shares precisely. Options move the market just as buying or selling the shares. There you go. Exactly what we're talking about here. So let's continue on. A call option example. Let's say that we have a coupon to buy a house at $100,000. Okay. We talked about our doubles earlier, but we'll use houses here. You have a coupon to buy a house at $100,000. The house is currently at $80,000. This is not a great deal, right? Let's say Brad. Let's say that you're out in, I don't know, Kentucky or something, and you're like, that's a pretty cool house. I got this coupon to buy it for $100,000, but it's currently valued at $80,000. Is that a good coupon to you?
No.
No. Would you pay very much for that coupon?
I wouldn't pay anything for it.
Exactly. Precisely. Right. Who would? That's why these out of the money options, which we'll talk about the moneyness in a minute. That's why the out of the money options here, they're just lotto tickets, right? They're just a gamble. They're just a hope and a prayer that something will happen. Because in this case, Brad, with his coupon, the house has to go up from 80 to 100 to even be worth the coupon in the first place, to even be worth anything for the coupon, right? It's not a great deal at all. But let's say Brad's house now goes up to 250. We're looking at this house that was 80. Things went crazy out in the market. Everybody's moving to Kentucky, bumping up housing prices like you can't imagine. And now that house is 250. How's that coupon look now, Brad?
Yeah, that coupon looks fantastic now.
Freaking yeah.
Yeah.
Freaking yeah. Right? It's an amazing deal because now you can get into that house for a huge discount. So how much would that coupon be worth to you now? A lot?
Yeah, absolutely.
Yeah, for sure.
You know,
But the thing is, Brad, this coupon wasn't free, right? This coupon wasn't free at all. But back in the day when that house was trading for $80,000, they were like, you know what? Pay me $10,000 because the market's going to go up at some point, and then you'll buy that house that reached a value of $250 for $100,000. Would it be worth the $10,000 you have paid at that time?
yes, it would be worth it. But like you were saying, you know, I mean, you're paying 10,000, hoping it's going to go up at least 30,000 just to get back to break even.
Look at you, right? You'd want to see the price of the house go up by the amount of the house plus what you paid for the option. Very smart, very smart. When you first bought the house, or first bought the $10,000 coupon, the house was at $100,000, and the coupon to buy the house at $100,000, our strike price, the house was currently trading at $80,000. So the real break even, just like Brad just talked about, very smart, Brad. Everybody give respects to Brad in the chat. Brad, everybody pay respects to Brad in the chat for being a brainiac over there. All good. The real break even on this trade is $100,000 plus what he paid for the contract here. So $110,000. Very good on top of it. But let's say you never want to own the house outright, right? Brad, you're like, dude, I got a sweet ass baller ass place over here. I don't even want that house. I was just going to do it as an investment, right? You could sell it to somebody else. You could sell it over to Paul. And Paul's like, well, you know what? I always want to move to Kentucky. I think now might be a great opportunity. but Brad, you're not going to sell that to him for $10,000 now, would you? Right? No, that house that went from 100,000. No, I'm sorry. The house went for 80,000. You bought it for 100 plus the contract price. Now that house is worth 250. So Paul's over there. Paul's the guy who's moving over to Kentucky, buying up all the houses he can. And he's like, well, I got to have this house too. How much is that going to cost Paul to do so? You think it's going to be a little or a lot?
I'll trade him
I'm going to put it up for a lot.
I'm going to trade him an old car for it.
2 sticks of gum, a 6-pack, and an old car. That'll work. But now this is where the option has lots of moneyness here. So the price of the house is now at $250. Paul's super stoked. Paul's ready to buy it today at $250. Brad could sell that coupon for at least $150. At least $150. That's how much moneyness Brad has in his options. Because remember, he bought the house when it was at $80,000 with his coupon at $100. Okay, the house was currently trading at $80. It went up. Brad decided he wanted to own that house once it reached $100. Now it's gone from $100 to $150. So Brad's coupon has $150,000 of moneyness. Right, so there's no way, not any chance whatsoever, that Brad should take less than $150,000 on that contract, on that coupon. Is everybody following?
Yep.
Right, because the market value just increased all that much. This is what we're trying to focus on, moneyness. This is why I buy the deep in the money options, because they already are full of that juicy, lovely moneyness, right? You just want to rub your face all in that moneyness. That's how much moneyness we have here. We don't want to go out of the money because they don't have any value. You can decide to sell the contract at any time or keep the house. The choice is yours, right? Brad, the choice is yours. You can sell the house. You can sell the contract. Do whatever you want to do. You're not obligated to do anything at the end of the day, right? You have the right to do whatever you want. So now we're doing the same thing with stocks. If the stock is rising, we can buy a call contract to lock it in at a certain price. to lock it in at that price. And the value of that contract will go up or down based on how much the price of the stock fluctuates. The option contract is a coupon to buy a stock at a certain price by a certain date. And the price of that option is going to change just like a coupon would if it's going deeper in the money or out of the money. JC, did you have a question?
Yes. Can you hear me?
Yes, sir.
Can you hear me?
Yes, sir.
Okay. You bought the house for 80. You have the 20,000. So the house is basically you've paid up to $100,000. Now it's worth 250. When you say I buy deep in the money, where in that 150 would you come in?
Still at that 100 point.
Where in that within the 250? What does that mean? I buy deep in the money. It's like, okay, so where would you, when the house is going up to 150, 160, 170, at what point would you be considered deep in the money?
Oh, okay. So at the money is where it is trading at that strike price. So once the house had gone from 80,000 up to 100,000,
right,
that was the coupon. That is at the money. That is at the money. That's
correct,
when it starts to get that moneyness, right? Then as it goes from 100 to 102, 103, 104, it really depends on your definition of deep in the money. For some people,
okay,
$10,000 could be deep in the money. For other people, it could be $150,000 is deep in the money. It really has to do with your time frame, right? Because if you've got 2 years from now, right, you want to be as deep in the money as possible. But if you've got like 2 weeks from now, you may not have to go that deep to get the same amount of moneyness. But I usually, and it's really easy on a broker's platform because it's really always at the 80 delta for me. But 75 to 80 delta, and we'll explain that more in just a little bit. That's where I consider deep in the money. There's out of the money, where it has no moneyness whatsoever, at the money, and in the money, right? And so the deep is somewhat relative. Good question, though. Now, we don't want to buy the stock outright in this call example here. We just want to trade the coupon on the stock because it's significantly less, right? Going back to the house example, if I could buy the house for 100,000, or if I could buy the coupon for 10,000, I would much rather buy the coupon. And then if I decide to take the house, I would have to pay the rest of the 100,000. But if I don't, and I decide to sell it to Paul, then all I had to pay was the price of that coupon. And you do this in your brokerage platform, just like we talked about earlier. It's the same place where you buy stocks. There's usually a button to switch between stock or option, and that's what you need to do. But you use what's called an options chain. Now, this is gonna break some brains over here. If you've never seen an options chain, you guys have. I know you're familiar with it, but I mean, I'll never forget the first time I saw an options chain like this. I'll never forget this. Right? It was in that conversation about Deutsche Bank. And I pull up an options chain and it looked like this. And I was like, whoa, okay. I don't know what any of these, I literally had this exact thought in my brain. I don't know what any of these numbers mean. I just want to make money. That's what JC is saying, right? I don't know what anything on this screen means. I just want to make money. How do I make money with all these numbers here? If that's what you're feeling, JC and everybody else, I've been there. I completely know where you're coming from. I had that exact deer in the headlights look. So the first thing to look at an options chain is up here in the corner, depending on their broker. In fact, let me make this bigger. Up here in the corner is showing you the price of the stock itself. So at the time that I took the screenshot, SPY was at $603 exactly, which is going to help as we go through a lot of this. 603 exactly. Now, you could buy any one share of SPY, the S&P 500 ETF, for $603. Okay, easy enough. We understand that. What you see across the top here are the expirations, just like the coupon example, getting the double by July 1st. You could buy any one of these strike prices, by any one of these dates, right? Like SPY has options. If it's not every day, it's like 3 days a week. Like there are so many expirations all the time. But there are some that only trade once a month. There's some that even trade only once a quarter, right? So depending on the stock, depending on the liquidity, depending on the excitement of that individual instrument, of that individual stock, it'll determine how many strikes there are, how many expirations there are, I should say. Now, down the middle here, these are your strike prices, right? So if Joe was going to sell me the coupon for the double for 50 cents, that would be like one of these, or it was the 99-cent coupon. It'd be like one of these being the 99-cent coupon, right? There's a $1.99 coupon, there's a 99-cent coupon, there's a $1.19 coupon, all those different ways, all those different strikes, right? So this can be super confusing, right? I have to pick the date of expiration, and then I have to go pick the strike that I want. Jeepers creepers. This is getting more and more complex. I understand. I get it. Let's try and break it down as small as possible. At the money, like we talked about just a moment ago with JC, this is perfect because it's $603. The at the money strike is the $603 mark. We can see that. It's exactly where it's going and flipping over from being out of the money to in the money is the at the money. Now, on the left-hand side, these are your calls. This is the calls. These are what go up in value as the price of the stock goes up. On the right-hand side, these are your puts. These are what go up in value as the price of the stock goes down, right? So remember, if you want the price to go up of the stock, you would focus in on the calls. If you want to trade with the price of the stock going down, you would focus on the puts. Okay. There's only two types of options, calls and puts. This is for when you want the stock to go up. This is for when you want the stock to go down. Now, delta. Delta is really interesting, and we're going to go deeper into the Greeks and everything on Thursday. But delta is a giant measurement for me. Delta is the rate of change for the the rate and change for the price of the option for every $1 move of the underlying stock. So let's look at this, for example. At the money is always 50 delta. Always 50 delta. So you look here, 51, you look over here, 48. It's always 50 delta, give or take. Now, when you see one that's 70 right here, that means the 589 strike for every $1 that the SPY moves. So it goes from 603 to 604. The price of this option will increase by 70 cents. Okay. Delta is incredibly important. And then we can go, let me move out of the way here. We can go out of the money and we can do the opposite, where this one moves 70 cents for every $1 that the price of the SPY moves. This one moves 31 cents for every $1 the price of the SPY moves. Right? So they have different levels of intensity, if you want to think of it that way. So delta can also mean the likelihood of it being out of the money. This is what a lot of options sellers base this on, but actually you can use that same approximation if you're buying or selling it. Because it's at the money, it has a 50-50 chance of being out of the money or in the money by the expiration date. Is the expiration date on here? It was July 11th when I took the screenshot. So there's a 50-50 chance it's going to be in the money or out of the money by expiration. You go deeper in the money, there's a 70% chance that the 589 strike will still be in the money by the expiration of this coupon. Right? And then if we look on the out of the monies, there's only a 31% chance that the 614s will be in the money by expiration. Okay? So what we're looking at with the delta has multiple different meanings. And generally when I trade, I look for the 80 delta. You can figure out a different delta that works for you, but man, does it make it simple. When you're logging into a broker platform and you say, I like to trade the 80 delta, I don't look anywhere else. I don't look anywhere else. Like all of this is noise. The only area I'm looking at is the top left corner. And in fact, I'd have to scroll up to get to the 80 delta here. So that makes life a lot easier if you know what you're looking for. Next, open interest. This is the amount of contracts that people want to trade, okay? This is different than volume. Volume is the number of contracts that have been traded. I don't even look at volume. I look at open interest. If there is a lot of interest on a certain strike, your liquidity is going to be better. You can get in and out easier. Like I'm actually surprised at the time I took the screenshot that this particular strike only had 148 contracts of open interest. On the SPY, that's super duper low. But this one here at 1930, there's way more excitement at that strike. Why? I don't know. Doesn't really matter to me. All that I care about is there enough open interest to trade with me? So my rule of thumb, whenever I'm looking to trade options, and I think Joe asked about this the other day, is I need to see 4 to 6x the number of option contracts I'm going to buy as open interest. So for example, if I'm buying 100 contracts, I want to see at least 400 contracts. If I'm buying 50 contracts, I want to see at least 200, right? But honestly, the outlier effect has kind of opened my eyes that, we could actually support a hell of a lot more contracts than I ever thought we could at those market prices. Dave, that really surprised me. And I appreciate you pointing that out the other day, because looking at the open interest of some of the contracts after we put it on, I was like, whoa, it is very obvious where we traded. And we did not have 250 in open interest at that point. But boy, there was a lot of people on that. So what did you see?
Well, what I went through and I looked at was the individual contracts that we traded. And I brought it up in Thinkorswim, created just a quick chart with that contract identifier specifically. And I could see the exact time when the orders went in. We saw an instant spike across the board, and it sustained for a couple minutes after that. So, everybody was playing catch up as the orders were going in. But I saw that across all 3 or 4 I forget what we had, but all 3 or 4 tickers, exact same effect hit during that. They were absolutely flat, small until we talked about it. And yeah, the outlier effect is real.
And so that, Dave, that really opened my eyes that, like, we talked earlier about the market makers, right? Mikey Mike the market maker. Mikey Mike the market maker. I like, that's a good nickname for you, Mike. Mikey Mike the market maker. So Mikey Mike the market maker is out there, and he's just selling all the contracts that he can hand over fist. It seemed like it wasn't an issue as far as finding a strike, even with, I don't remember what it was, probably 300 or so. And we got everybody who needed to get filled got filled. So I don't know. Yeah. At least it was not the opposite, right? If it were the opposite, where it's like, okay, we're not selling any more to you guys, what would we do at that point? I don't know. Yeah. But at least that's the market maker's job. That's Mikey Mike, the market maker's job, is to be there and provide liquidity for when people want to trade. What's
David,
up,
did you see the open interest numbers change after you saw the spikes?
I did not look at the actual open interest numbers. I was actually looking at a charting. I was just throwing them up real quick. I wanted to see if there was an effect. And now that we know that there is, I'm going to probably look at that a little more, try to get some screenshots before and after and see.
Did we trade more contracts than there was open interest initially?
Yes. Oh, for sure. I actually looked at the open interest later, and that's where I was surprised. That's actually, so Dave pointed out, and then I looked later on, and the open interest was several thousand at that point. And it was like it was an isolated one strike where we were. And I know that it didn't have several thousand open interest when I was putting the trade on. But yeah, for sure.
Yeah, so we made the market maker build those contracts for us.
Exactly. Yeah. What's up, Brad?
So when you're talking about the open interest, is it because the trading game is a zero-sum game? So you need to have someone to assign your contract to when you go to sell it, or when you go?
That's a great question. So this is not like the Fed. We can't just print unlimited contracts, right? This is not contracts go burr, right? So this is where the market maker has to do his job. Their one job, and it's not like a dude sitting there like, oh, I need to go do this or that. It's all computer automated at this point. But Mikey Mike's running his computer program, and he's like, okay, a buttload of these outlier guys are out here buying the strike. What do I got to do, right? I have to provide them liquidity. That is my one job. So I need to go and I need to sell them contracts. And then I need to go offset my risk by buying more stock. So yeah, Manny says we're gonna get banned. We're buying too many contracts. They're on to us.
There's always somebody willing to take your money.
That's true. That's true. So at the end of the day, what I'm looking for is high open interest. If I don't see high open interest, then I'm not interested, right? I've come into plenty of options chains, and it's been like 0.0003007. And it's like, oh no, I'm not playing that game. I don't know how they're going to fill those. We want as much open interest, as much liquidity as we can. So whenever you are actually ready to buy your contracts, right? Which button do you push on here to buy? Well, you would actually go into the chain and click the number. I know it sounds weird, but in order to do this, you have to go into the ask column, and then you click the number on the strike that you want to trade. Now, listen, Chris didn't understand that for a long time. I'm clicking the mess out of this. And I'm like, where the hell do I click, right? No. You go to the ask column, and you click where you want to buy. Now, when you're ready to sell, right, you've bought it at one point, you got to sell it back at another point. You go into the bid column and you click that button. Okay, there will always be a bid and an ask spread here. That's the market maker's fee for providing you liquidity, right? If I'm going to buy it at 1507 and sell it back at 1502, that nickel, that goes to the market maker for doing his job. Okay. So intrinsic value. Ooh, boy, does Chris love intrinsic value. Notice intrinsic value going up by $1 every time right here. And now this is why it was so handy to get this screenshot right at 6:03 exactly, because as you're going into the money and going up one strike at a time, it's getting $1 more of moneyness every dollar it goes deeper into the money. How cool is that? This is a perfect example that I managed to take. Now, extrinsic value is different. Notice there is no intrinsic value on the option when it's out of the money. There's no intrinsic value out of the money. Remember the housing coupon we talked about earlier. Brad could have bought the coupon on the house with the 100 strike when it was only trading at $80. That would be equivalent to Brad buying the 608 when it's trading at 603. Right? There's no moneyness to this, right? Like Brad said earlier, it doesn't have much value because the house has to go up in value for it to be worth anything. And the deeper it goes in the money, the more value it grows. This number right here is the number we are trying to maximize on every trade. Every time you trade an option and you're trying for it to go up in value, you're trying to maximize the intrinsic value. Now, what is extrinsic? Extrinsic is the uncertainty value because there's time associated with this, right? There's at the time that I took this screenshot, there were 29 days until expiration. That uncertainty has a value to it. We don't know if it's going to go up. We don't know if it's going to go down. So the person who is selling that coupon, they get to earn some uncertainty value. I mean, I want to pay as little uncertainty value as possible. I want this to be a sure thing. We can't ever have a sure thing in the market, but we want to minimize how much uncertainty value we're going to pay. Now, also notice the uncertainty value is greatest at the money. See, it's $3, $4, $5. And then we go deep in the money, $5, $6, $7. And you can see it converges right here. Right? If this were a pyramid, it would pyramid right to at the money. Why would it do that? Because this strike has the most uncertainty. We don't know if this one strike at the money is going to be in the money, gaining intrinsic value, or out of the money with no intrinsic value. And here's the other kicker. This is where people get really effed over in options trading. Bigly effed over. Hang on, I got to ban someone in the chat. He's acting like a jerk. All right, you are permanently banned, Eric. Goodbye forever. So extrinsic value. This is what you are trying to minimize. Intrinsic, you want to maximize. Extrinsic, you want to minimize. Why? Because extrinsic value goes to zero on every stock, on every options chain, on every expiration, every single time. Okay? Always, 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 always. Extrinsic value at expiration is worth nothing. And I like to use this quarter sitting on my desk in front of me as an example. This quarter is worth more than an out of the money option that has expired out of the money. That's it. It has no value. And because of that, that is why people get freaking hosed in options, because they do not understand That this is not like a stock where if it goes down 1%, you still have 99% of your value. If it goes out of the money and expires out of the money, it is worthless. Just like if Brad were buying the house and the expiration date came and went, and the house was still valued at 80,000, never went up to 100,000. That coupon has no value anymore, does it, Brad? Right? That coupon to buy it for 100,000, who cares? That's nothing.
Right.
Are we understanding why we want to minimize extrinsic and maximize intrinsic value? Cool. All right, next, let's talk about the expiration dates. Across the top, lots of different expiration dates. And let's move into this example right here. This is the 610 strike. Remember, SPY's trading at 603 at the time of this recording, at the time of the screenshot. The 610 has 8 days for it to go up from 603 to 610. It has no intrinsic value at all whatsoever. It has only extrinsic value. It has some uncertainty value to it. But if we compare that to the 590, it has 8 days to still stay in the money. If it still stays in the money, the extrinsic value will go down. But this intrinsic value cannot be changed if it expires at 603. Okay? Extrinsic value, let's do the math here. Let's do the math so we can follow along. Extrinsic value plus intrinsic value is the price of the option. Okay? So let's do the math here. Take the current price of the stock at 603, minus your strike price at 590. That gives you $13 of intrinsic value. This is the amount we're trying to maximize. But wait a minute, the price of the option is not $13. You're right, because there is still some uncertainty of what's going to happen with it. So that price is $18.89 minus, oh, I did that wrong, didn't I? $18.89 minus $13 gets $5.89. That is your extrinsic value. There's a couple pennies here and there off, but that is how you get the extrinsic value. That is the uncertainty premium that you are paying anytime you buy an option. This is the intrinsic moneyness of it. That's the difference between the current price and the strike, and the difference between the option price and the extrinsic is, or I'm sorry, and the intrinsic is your extrinsic value. Everybody following? Good? All right. Give me a thumbs up if you're understanding. This is deep finance theory right here. If you guys can understand options, you can make ungodly amounts of money in the market. Now, let's talk about this, right? The options multiplier. The options multiplier means that every one contract you buy is worth 100 shares of stock. Now, this is where it gets really cool. This is where it gets really, really, really cool. So if we're looking at this example options chain right here, $19 would be the price of the option to get the 589 strike. And I think of it as a per share cost. So looking at this, right, I could spend $18 per share and control 100 shares of stock at the 590 strike. Now, I don't know if that made sense conceptualizing it, but this is where I like to say you can actually trade at a 90% discount on every stock you buy. Because if we're looking at the price of the option and you're paying on a per share basis and you're controlling 100 shares of stock and it costs you $19 on a $600 stock, that is a tremendous value, tremendous leverage that you just took. Now let's do the math on this one. Right, if we're looking at, let's do the 590 strike again. $18.89. The current price of the stock is $603. That means we're only paying 3% of the stock price per share. This blows people's minds. And this is what Larry Hite loved. This is what Larry Hite taught me. He's like, Chris, this is the greatest deal on the planet. If you figure this out, if you understand how to do this, you will have generational wealth. You're trading the coupon at 3 cents on the dollar for every dollar of the stock price. You're buying the stock for 3 cents on the dollar. It is crazy. It is so cool that we can do this. Now, remember, there's only two types of options. We covered the call options. Now, let's go a little bit deeper into the theory of the call options here, right? The call option gains intrinsic value as the price goes up. Gains intrinsic value. That's what we're looking for as it moves deeper into the money. Remember, let's go back to this one here. Dollar for dollar that it goes deeper in the money, it grows an intrinsic value. That's what this is looking like here. Dollar for dollar, as it goes deeper into the money, we're gaining value. How much can you lose on an options contract, right? We talked about all the upside. Let's see. Who wants to answer this question? Joe, how much can you lose on an option contract? How much can you lose specifically on a call option contract?
What you paid for it because you let it expire.
But wait, Joe, I thought options were risky.
Selling options is risky.
Wait, why would selling options be risky and buying call options not?
Because you have no floor to your loss on a selling of an option.
Hang on. Explain that to me just for a cotton picking minute here, Joe, right? Let's do it this way, right? Tell me exactly how much money I could lose in this, right? Looking specifically right here on these numbers here. Joe, how much could I lose on this trade? What is my maximum loss on this trade?
It looks like 10, and I'm assuming dollars.
So you're telling me that the most I could lose on this trade is $10?
Yeah, it's great, isn't it?
Okay. How much can I make on this trade?
Infinity, well over 40.
Hang on. That can't be right. You're telling me that I can spend $10 to buy the coupon, buy the option contract, and the very worst I can come out is losing $10. But the very most I could come out is infinity?
Yeah. As long as you buy it, not sell it. Make sure you hit the right button.
Well, that sounds pretty dang good, doesn't it?
Yeah.
Okay.
But I think in reality, you're not going to let it expire. So you're never really going to lose $10, right? You're going to lose something less than $10.
Well said. Well said. Now let's flip this around. And because I do not sell options, explain to me why selling options would be a bad idea in this case. Because if the most I can lose is $10, but I can have infinity gains, well, what about the guy who sold it to me?
Let's see. How about Paul? You got that one, Paul?
Look at you pass the buck. Okay, Paul. On the spot.
My mic doesn't appear to be working. I think I saw Dave raise his hand.
Oh, okay. Listen, class participation is a grade. Okay, guys, let's go here. Come on, Dave, bring us home.
I'll bring you home. You are capping your potential upside. So if you go and sell a call option, covered call on this, you sell that, you're completely capping your upside gains if you're doing a covered call. So say you sell a $5 one and the stock goes to $8, you just lost $3 worth of gain for the few cents that you would have sold that contract for. Not worth it.
Okay, so let's say here, right? Dave, you and I, we each sold an option contract to Joe. Joe's taking us to the house, right? Joe has unlimited gains on top of it, right? But you and I, as the option sellers here, who's paying for Joe's gains?
We are.
I don't want to pay for Joe's gains. Screw Joe. I don't want to pay for his.
Mm-hmm.
I don't want that. I don't want that responsibility. Joe's out there making Lambos all day long, buying new mansions and helicopters and private jets, and I got to fund his lifestyle? Is that what you're telling me?
100%. You gave it up for those few pennies. You got the value meal and not the double-double.
Then why in the wide world of sports am I out here selling options? If I have unlimited risk for making $10, Joe, on the other hand, bought that option for $10, and he has unlimited profit potential. One of us is in a great situation. The other one of us is making terrible life choices.
Pennies in front of a steamroller.
So this is why I say never sell options. There's no point in doing so. To pick up the itty bitty baby amount that you're going to earn when guys out here like Joe are stealing your money, stealing your house and home because he's making all this dough. and you thought you were clever to pick up the $10 on the other side. I'm telling you, I was that guy for years. And once I figured out, like Steve, when he slapped me across the face verbally, I used to trade that way until I realized I wanted to make money. Until I realized I want to be like Joe over here, who's picking out the color of his Lambo, right? That is the reason we do not sell options. Okay. So going back to this here, the maximum that we can lose when we buy the option is $10. How much can you make on an option? On a call option here? Theoretically, infinite. If it continues to go up forever and ever and ever, it could literally go up for, in fact, let's go to Robinhood. I was looking at this one earlier and having a bit of a, damn, that's so cool, except I'm not in that trade moment, right? Because I traded it down here when it was in the 50s. And now it's up in the 80s, right? So whoever sold the option is losing their house. They just got a divorce, right? They're having to sell their car piece by piece to fund the people who bought this option, right? Now, I'm not bitter. You're bitter. But looking at this, I'm like, wow, this is what it looks like whenever you have the unlimited gains right here. Pretty cool, right? Pretty cool to see what that would look like in practice. So what's your break-even point? I'm going to call on JC. I love you, my friend. And I know that you're new into the options world. Do you feel like taking this question? What's your break-even point on this trade? Oh, I think you're muted. There we go.
Okay. When it crosses the zero line, I'm at break even.
Yes, exactly. You're exactly right. And he does that when the price, the strike price is hit, plus what he paid for it.
Right.
Right. So Joe bought it for $10. So the break-even price when he had the 100 strike is 100 plus the $10. That's his break-even point. Does that make sense?
Got it. Okay. Yeah, I had to read the bottom number. Yes.
Yeah, exactly. And that goes back to the house example earlier, right? I think Brad got his gold star earlier in the class because he was like, hey, you know what? I need it to go up to the strike price plus what I paid for that option. Boom. There you go.
Got it.
Don't sell options.
What if you happen to be holding the stock already because you're a bag holder? Does it ever make sense to sell options against the stocks you already own?
You can do that. That's kind of like what Dave was talking about with the covered calls. It's you. I mean, in theory, by selling a covered call, you are taking in what that person bought it for. So the $10, right? In this example, for the $10. But if it goes in the money, your shares are going to get called away from you. So you're no longer owning those shares, but you still got to keep that $10. Wasn't it awesome? Yeah, not at all awesome. So call option example. When you first bought the house when you first bought the $10,000 coupon to buy the house at $100,000, the house was trading at 80. Remember, the house was out of the money at that point. Your real break even, like Brad mentioned earlier, is $100,000, the strike price plus what you paid for the coupon, so 110. I told you guys this was going to be a deep lesson. We hadn't even got to puts yet. We hadn't even got to puts. So, let me see. So your real break even is this. So it's the strike price plus the cost of the option. That's what I want to get across here. Now, a call option example. So this is it going in the money, right? So this strike went into the money, right? So imagine that the 510 was out here out of the money. And then it moved and it moved and it moved. And now the 510 is deep in the money. That would be it going from out here to having no value to over here having value. So let's take this a little bit deeper here. Imagine this was the 590 at one point in time. Now the price went up and the 590 is in the money. You bought the 590 call for 595 when it was trading at 590. You sell the 590 call for 1889 when the price of the stock is at 603. So your profit in this case is 1889, which you sold it for, minus the 595 that you bought it for. That's $12.94 in profit. Now, in this example here, when the price was at 590 and then it went up to 603 on the stock, that was a $13 change, so a 2.2% change. But the options price went from 595, right? Went from 595, and we took $12.94 in profit, means that the option price had a 217% gain. Let me slow that down for you here. This is why we trade options.
I think they call that an outlier gain, Chris.
That is an outlier gain. Yes, exactly. The stock price went up 2%. The option price went up 200%. Do you see why we trade options? Huge gains, right? Exactly what we are looking for. Now, put options. Actually, Robert has a great point. Robert, thank you so much for this point. In general, option sellers are more profitable because around 2/3 of options expire worthless, right? So to that point, Robert, bro, thank you so much for saying this. So let's go over to that real quick. Let's go, hang on. Let me go to the options chain. So what Robert's talking about is 2/3 of these options expire worthless. I completely agree with you on that. But on this example earlier, where we talked about how much the loser can lose in this case, that is where Chris, I mean, obviously Robert's way smarter than me because I couldn't make money selling options with an 84% win rate, because one loss would be equivalent to 6, 8, 10, 12 of my winners. Let me repeat that for those listening in the back. When I sold an option and I lost on it, it would take me 6, 8, 10, 12 times to make back the one loss. So even though all of those expire worthless, expire out of the money, for me, I was getting monkey hammered all day, every day. So it is, you know what? If you feel comfortable enough taking humongous risks for small profits, that it go sell all the options you want. No, I'm not speaking to Robert individually. I'm talking to everybody, right? But if you would rather take small risks and have huge profits, that is the outlier way. That is the way that trading is done. So let's move on here. And Robert, really appreciate you pointing that out. Now, we don't have as many slides on puts, but we are still going to go through and explain what puts are. They work the same way as call options, just to the downside. Okay. Remember, two types of options, calls and puts. Puts increase in value as the price of the stock goes down. So it's basically a mirror image of the call options. Okay. As the price of the stock is going down, the value of the put is going up. The put is gaining intrinsic value as it moves deeper into the money as the stock goes down. Now, how much can you lose on a put option? Okay, I'm going to put you guys on the spot. Let's say you bought a put option there, Deep Thought. You remember being in class?
The maximum you can lose will be $10.
Exactly. Yeah. I was just going to say, remember being in class as a kid and like the teacher calls on you, you're like, oh shit, what? I was definitely trying to pull that on you guys. So yeah, you're looking at this and a put option, the most you can lose on it is the $10, the $10 you spent to get that right. How much can you make on a put option? Mike, how much could you make on a put option?
I'm going to guess infinite amount. And I'm wrong, right?
Infinite amount with an asterisk. So you're 99% right.
Okay.
1%.
I'm still trying to understand this chart where you saw the $10. I'm still trying to see where the $10 mark is that we're okay. I was reading right to left, or left to right, I mean.
So yeah,
okay.
This is the price of the stock, and this would be how much you paid for it.
Okay.
The asterisk in this case would be the fact that can only go down to zero, that underlying stock price. So that's the maximum you can theoretically make from it.
Nailed it. Deep Thought nailed it. Yes. So with a call option, it can go up to infinity, right? You could buy a $10 call option and it goes up to like, what is Berkshire Hathaway? $600,000, right?
742 last year.
There is no cap on that. But when you buy a put option, the cap is 0. Right. Once it reaches 0, it can't go any further than 0. So that's where you're going to max out. But in theory, it's going to look a lot like this, and then it's just going to hit a wall.
Can you roll those?
Oh yeah, sure.
I didn't know if it works some different way. Okay, I haven't messed with puts, so
yeah, dude. I bought one put, or was it 2 puts? I bought 2 puts this year, two different trades this year. That's the first puts I bought since 2022. Right, in a bull market. Don't be buying puts. In a bull market, don't even think about buying puts. If you buy puts in a bull market, you're going to get monkey hammered to death. Okay? Do not do that. But there will be a time, there will be a place. In the meantime, don't get monkey hammered. Now, let's go. Oh, JC, what's up, my friend?
I don't understand why the graph is like that. Low and then flattens. Shouldn't it start flat and then drop as the price is dropping?
Okay, I hear what you're saying. So on the x-axis, that's your stock price. This is the value of the option. So over here, as the price is going up in value, then you have maxed out your loss. But as the price of the stock is going down, then the value of the option is raising, as that's your profit on the left axis.
Got it.
Yeah, for sure. All good, man.
Okay.
No, you're great. Dude, this is deep stuff, right?
I'm reading it the wrong way. That's all.
No, it's all good. I mean, no 1 hour lesson is going to ever be enough in options trading, right? But doing this on a daily basis, like Dave just shook his head. Doing this on a daily basis, dude, I'm telling you, I am a jump into anything with both feet kind of person. When I jumped into trading options, like I was literally dreaming about iron condors. I'm never going to teach you what iron condor is. I don't want you to know what the iron condor is, but boy golly, was I dreaming about iron condors in my sleep. And yeah, dude, like you have to get super deeply involved into understanding these type of things. So what is the put option? The price of the option minus the strike price. What is that? That is our break-even point. Yeah. So same thing that we did earlier. It's $100 minus the $10 you paid for it. So your break-even point is 90.
90. Got it.
So looking at this, right? The same thing as we did earlier, but on the flip side, if the price went from, let me see if I did this correctly. Okay, if the price went from 603 to 590, right? From 603 to 590, now you're going the opposite direction, right? And we're looking at it rising as it goes from 603 down here to 590. So, like our example earlier, you bought the 590 put for $5.53 when it was trading at 590. You sell that put for $13.29 when it's at 603. Now you've got a profit of $12.94. I might have got that backwards. Yeah, I think I did. Sorry. Well, let's go ahead and delete that because I feel like I need a better explanation of that. So this is the opposite of a call option. As it's going down, the price of the option is going up. So apologies for typing that in wrong. So to recap, 2 types of options, calls and puts. Right? We're only focusing on buying them. I never want you to consider selling them no matter what. Drawbacks to options. You can lose the full value of that option if you don't control your risk. And that's what I meant earlier is that this quarter with the date of, what was it, 1990, I think. Yeah. This 1990 quarter is worth more than any option that expires out of the money. That is really sobering to a lot of people because they will YOLO into options thinking that, they're going to be buying their Lambo by the end of the week, probably 2 Lambos by the end of the week. But then they don't have 2 quarters to rub together, right? Because they literally can go down in value that fast if you don't know what you're doing. And I want to make sure you do know what you're doing, okay? It takes time to fully understand these, right, JC? It's not going to take an hour to get through this, and so don't stress on that. And the other thing is that time can work against you. If you are in a long option and your stock's not moving, every day that uncertainty value is going down, right? You bought that uncertainty value. You paid for that. You can't avoid that uncertainty value. But every day that ticks by, it's getting a little bit more certain where it's going to end at expiration. That's just a fact. And option sellers, they bank on that. They're like, oh, you know what? These idiots, they're buying all these options that have the high uncertainty value, the high extrinsic value. I'm going to sell it to them. And as every day goes by, we are getting more and more certain where it's going to end up. And so that uncertainty value will decrease every single day. If you are buying the options, the time does work against you. Okay, it's just a fact. And that is something that we are afforded through the leverage, and it's part of the leverage. Now, homework. If you have not finished watching this video, please continue watching it, right? I gave you guys an extra week to go through this video. It's over in the Outlier University playlist. I know several of you guys said you've watched it at least once, maybe more than once, but you definitely want to finish that video before next lesson on Thursday. On Thursday, we're going to be talking about the Greeks. We're going to be talking about which option strike I would go for, which you guys know this already because you've been following Outlier for a while. But for those of you who don't know, there's lots of different option strikes. Which one do you pick, right? Nico, 0 DTE. So 0 DTE has become a huge thing in the market. 0 DTE means there's 0 days to expiration. It expires today. Right? I feel like this is equivalent to somebody walking in a casino and putting it all on red or black. Either going to work or not. Lambos or food stamps. Here we go. No, please don't do that. No. This, and I know Nico is just joking around here, but that's become such a huge part of the market is 0 DTE options. People just coming through and gambling. Oh, it's going to go up. Oh, it's going to go down. Versus I'm going to take a leveraged investment and let's see if it works. If it doesn't, that's fine. I'm going to get out. If it does, cool. I'm going to hold it for as long as I possibly can. Okay, so I'd like you guys in the chat to start putting your questions. Do me a favor and put #Q and then type in your question, and we'll spend 10 minutes or so answering your questions. But for the gentlemen here in class, what's on your mind? How can I help you out? Do you have any questions on this lesson or anything else that I can help you with? What's up, dude?
So I was watching the video that we had for homework, and he mentioned something I had an inkling about before, but he was saying that your implied volatility and the price of an option can actually change. It could cost you more or less when you go to the option chain without the price of the stock moving.
This is facts.
I just want to see if that was your experience, or
you want to go down that rabbit hole, huh, Paul? Thanks a lot. Yeah, I mean, I hope you got 30 minutes to kill. All right, so let's talk about implied volatility. That basically gets equivalent to the extrinsic value, the uncertainty that we talked about earlier. So implied volatility can spike before earnings. Before earnings, implied volatility is going to grow and grow and grow because we don't know what's going to happen at earnings. Nobody knows what's going to happen at earnings. And because of that, more people are flooding in, more people are buying calls, more people are buying puts. Market makers are jacking up the price of the options because of that. And the implied volatility means that there is more likelihood of bigger moves to go on with that stock. Now, implied volatility can change from stock to stock, right? Coke and Tesla have very different implied volatilities because Coke's a boring stock, Tesla's an exciting stock. Even if they were trading at the exact same stock price, the implied volatility on Tesla would be tremendously higher because its movement is a lot higher. Probably would look similar to ATR if I had to guess, right? Because we look at ATR. I know you guys know what ATR is. We already covered that. But that ATR rises and falls as the volatility of the stock rises and falls, right? That uncertainty of what's going to happen. Dave, what do you want to say?
I was just going to say, related to IV, on Thursday, maybe a slide or two on IV crush might be appropriate and why earnings plays are not good.
I'm making a note. You saw my eyes roll all the way to the back of my head.
Yep.
Because
that's an expensive lesson for most people right off the bat.
Yeah, F that noise. I don't want to do that ever again.
No.
So we'll have a little conversation on it now. We'll cover it more later. But when there is elevated implied volatility, going into earnings is a perfect example. That always happens. Elevated implied volatility. Once we know what's going to happen, right? Once the earnings come out, prices are moving up or down, whatever they're going to do, or even going sideways. the implied volatility is going to crash probably within the first 2 hours of trading. Like it happens that fast. It won't be by the end of the day. It'll be long gone by the end of the day. So if you bought an option the day before and the price of the stock didn't do anything, that option may have lost 60% of its value within 2 hours because the implied volatility was jacked up so high. The uncertainty value was jacked up so high. And then we figured out what's going to happen. So the uncertainty value collapses because we see what's happening actually in the price of the stock. And my worst, well, maybe not my worst, but man, biggest lesson I could say learning around options and trading earnings was trading an iron condor. And I'll explain this deeper on Thursday. But in iron condor, you're selling a spread on both sides of at the money. So 2 out of the money spreads, one put spread, one call spread. And the objective here is when you sell it, the price going down because the implied volatility got crushed, right? I've sold it because the uncertainty value is super high, and then the uncertainty value is to come down. Now, did that work many times? Yeah, 8 out of 10 times it worked great. The 2 out of 10 times I got freaking hosed, right? It just happened over and over and over. There's no winning in options whenever you're selling them. There's really not. The old adage is picking up nickels in front of a steamroller. In fact, I'll spend just a few minutes talking about long-term capital management on Thursday. Long-term capital management. Have any of you guys heard of long-term capital management? Raise your hand if you have. Oh yeah. So long-term capital management thought they were the smartest people in the world. Like they literally were selling their investment on, like they were a hedge fund. They were like, come over to long-term capital management. We have the smartest, like literally, this was in their pitch deck. We have the smartest, most brilliant people in the world. We are going to make so much money with this strategy of selling options. We can't lose.
They had some Nobel Prize winners at their company. Yeah,
like legitimately, they touted themselves as the smartest people in the world. They sold options. They got blown up, like destroyed. Like it was an apocalypse because they were selling options, right? We talked about earlier when Joe and I were going back and forth about how I'm financing his lifestyle, right? And dude's out, buying Lambos on my dime. That's exactly what happened in long-term capital management. They got destroyed. So I want to share that story on Thursday. Cool. Any other questions from you guys? Mike, what's up? Mike, you Mike the market maker.
Yeah, that's a great title. I want to go back. Dave was talking. He watched when we were all making the same trades, or in the delta and the open interest. I was trying to understand that. So the open interest, whatever it was, say it was 250. We ate that up. I'm trying to get a hold of what you saw, Dave. As far as we ate all that up, and then somebody came in and filled it up again. Is that what happened, or can that happen? Is that?
It's. I'll let Chris answer that one a little bit.
So to your point, we did eat all that up. We ate all that up and then some, right? We went to the buffet, we took everything in the buffet, and we were still hungry, right? So then we ate the cats out back in the alley, right? So who provided the cats out back in the alley? That was you, Mr. Mike, the market maker, right? And so that market maker had to then go out and sell us contracts in order to fulfill the demand that came in on that option strike. So
why do we look at the open interest then? If how am I going to word this? I mean, if that can be done, I mean, why couldn't it just be there's only 10 and we ate all 10 and now the guy still has to do the same thing? Why do we look for 250 if that can still be filled even after we eat it all up?
Dude, I'll be very honest with you. That was the first time that I actually came across my board. I did not know that we would be able to make that sort of dent and take in probably 20 times or more than the open interest were available. I mean, legitimately, if there were 200 available and we put in 6,000, that's what it looked like. It was crazy bonkers. So that's one thing I actually am thinking about is where does that break, right? Where does that actually break? Where is too few? Where is not enough? So that's something I'm going to be looking at as well, Mike.
Okay. Yeah, that just seems
Hey, David, we could go back through Thinkorswim, the on demand, and take a look at the open interest, and if we pin down when we bought those options.
Absolutely. I just haven't had an opportunity to go back and look at it. It was just that quick review that I did that day. But yeah, I mean, very notably, there was a spike there. And I guess my larger question would be, we want to go to the restaurant everybody else is going to. That's the good restaurant. Everybody likes it. We know that. The chefs are good. Would we have the same reaction if we went to a strike with fewer open interest? In other words, would the algorithms on the back end say, what's happening? Why do we see this? Maybe we don't like this, versus everybody pile into this restaurant because everybody likes it. So let's keep cooking and keep doing those contracts. Would it create a red flag? I don't know on the back end.
I don't think so. From what I've seen and heard and understand is that the market maker has to provide liquidity, right? That is their actual job. And if all the open interest is taken up, then they have to go out and they need to create new contracts and sell that to the people who want to. Now, they don't have to price it the same, right? They don't have to keep the same pricing at all. They could widen out that bid. In fact, that may be the first thing that started happening is they widened out the bid-ask spread really quick and said, wait a minute, something's not right here. We're not going to take this 10-cent bid-ask spread anymore. We're going to take a 50-cent bid-ask spread.
So you're saying we need to trade at 3 p.m. on trade days instead of 4?
Dude, I don't know.
But that was, to that point, that was what caught my attention. And that's why I did my quick analysis is I saw the bid-ask spread start to get a little wider all of a sudden. Everybody's saying, hey, well, I'm not getting filled. It's going up and up. Because that spread was getting a little bit wider. There was a market reaction to the impulse that was coming in.
Yes, exactly. That doesn't surprise me at all. Like that was the first thought I had was, okay, if they are filling this and there's thousands and thousands of extra contracts coming through that I didn't even think about, they're going to have to make sure that they get paid appropriately. So you're going to have to pay up for those options to get them in the first place. Yeah. Super interesting, right? So to that point, that's something I want to research as well. Is where is that breaking point? Is it 200? Is it 50? Right? I'd never even considered an option if it's less than 200. Right? I might fudge a little bit from 250 down to 200, but if we can still make it all happen at 50 open interest, if they fill everything and it might maybe widen out 10 cents, that just opened up so many more opportunities for us. You realize that, right? But yeah, that could do some really cool stuff.
Now, I'm willing to trade that with your money.
Ah! Well, listen, if it fits the outlier 9, then I'm willing to trade it too, my friend.
All right.
Let's see. Let's go through some questions in the chat. You guys are a ton of fun to hang out with here. Oh, you know what? Stocky Locky had a great question. How much does it cost to get an Outlier membership? Well, in fact, it's just 82 cents a day. Head on over to outlier.com, pick up the annual pass for just 82 cents a day. Or if you're on the monthly plan, you can upgrade with one click to save 64% off the regular monthly price. I may have said that a couple times. I got that memorized pretty well. Thanks for Stocky Locky for that little layup there. Albertone asks, is IV tied to ATR? Well, that's a good question. And I mentioned that earlier. I think that ATR is a good representation of implied volatility. Remember, implied volatility is that not unsure. What am I trying to say? I'm totally blanking out right now. Hold on. That is the uncertainty value. That's it. The implied volatility, the uncertainty value is going to expand when things are happening that we don't know what's going to be the outcome, right? Like, for example, the actual war, the 12-day war between Iran and Israel, right? That expanded implied volatility on a lot of stocks, just for a fact. We may not have even noticed it, but if you were trading those options, your option price grew because of the implied volatility. And then let's say that you had bought oil stocks or options on oil stocks, right? That could have expanded too, because of, we don't know if Iran's going to shut down the Strait of Hormuz, which could have caused the oil market to go insane. But they didn't. And so the implied volatility got crushed. And so now you're seeing a lot of movement in oil prices actually coming down because people thought, hey, this is going to happen, right? War is bad for oil prices. They're going to go up. And then 12 days war, it's over. Now oil prices are collapsing. So that implied volatility is also collapsing as well. Nikolai asked, does it make sense to set an alert to control option trades? Just not get in the situations like what happened with HIMS yesterday. It dropped 30%. So that really comes down to position sizing, right? Of course, you can set alerts on anything, right? You can set an alert on an intraday stop. You can set an alert probably inside of your broker, or a stop loss right on that options contract inside your broker. I don't recommend to do that. Even if you were in HIMS and it gapped down and it absolutely monkey hammered you to death, but you wouldn't have done that in Outlier because Outlier actually had a lot of bearish signs ahead of it. But you do you. If that had happened, position sizing will save your ass, right? Because you are limited to how much you paid for those options. So if you position size correctly, of course it's going to hurt, but it's not going to take you to zero if you've position sized the right way. Great question though. CMAC says, when you sell to close the contracts, are the market makers buying it back usually, and therefore that contract no longer exists and no longer part of the open interest? That's a good question too. I don't know, right? I really don't know if that comes out of the open interest pool because it's closed. I would assume so, because on the back end, they know if it's a buy to open versus a buy to close, a sell to open versus a sell to close. So I would assume that it does come out of the open interest pool.
So Chat GPT is saying that open interest is only updated at the end of the day, but that doesn't sound correct from what Dave was telling us.
There you go. I'm not sure either, but these are definitely things that I can learn and we can improve our trading plans on, right? Really good question from Jeff here. Chris, what's your thoughts on options with wide strikes? So $2.50 or $5. My experience is don't do it unless you're deep in the money, but I'm sure you've had success with them. So what he means by wide strikes is, let's go to something. What's an expensive stock? Nvidia. What was that?
Costco.
Oh, Costco.
Yeah,
sure. Dude, Costco stock has gone bonkers. It's over $1,000. So last time I looked at it was 600. I was like, what just happened here? Okay, to that point, these are wide strikes, right? This is $2.50 wide. If I go out to August 15th, this is going to be $5 wide. If I go out to May next year, they are $20 wide, right? First off, you can absolutely apply everything if a stock has $1 wide option strikes or $20 wide option strikes, right? You're still looking for, if you've got enough liquidity, look at this. There is no open interest in here, right? There's nobody who wants to trade this right now. Versus if we go to June 27th, go closer to the money, lots of open interest here, right? And so back to that question earlier, I don't know. Maybe I do want to trade the one with 20 open interest. I don't know anymore. My whole world has been rocked because of this revelation by Dave. But you know what? I'm going to learn. I'm going to improve. And I'm going to see if all of our friends that are market makers like Mikey Mike over there can sustain whenever we start buying thousands and thousands of contracts now. I think this is a great opportunity for us. But to Jeff's question here, dude, I have never had an issue with wide strikes like this. In fact, like just treat them as any other strike. Just treat them as any other strike.
Would you still do the 50-cent spread on that?
It depends, right? On spread, yes. Now, reason being is that like you lose that money, like it's gone. That is your fee to play. I don't want to pay any more than I have to pay, right? To play. So even though this is, what is this, $1.40? I mean, that's really expensive. In fact, let's do a little math here. Do a little math. We're looking at the 1,000 strike down here. If I bought it for $8.85. And then, typed that wrong. Let's just say $8.75. And then no. Let's keep the example, right? $8.85 minus the $7.45 to sell it back. That's $1.40 that I gave up. So $1.40 on $8.85. Come on. Means I just gave up 16% of my option. My option is now worth 16. My investment is now worth 16% less just for the privilege to buy and sell. That sucks, right? I want to minimize the bid-ask spread. In fact, like even on the SPY, check this out. We go at the money on Costco. It's $1.40. We go at the money on SPY. And closest to that point was here. It's 3 cents. And this is still a $600 stock. And that's because there's that much more liquidity here. The liquidity is easily judged by looking at this. Right? If the bid-ask spread is tight, that means there's lots of liquidity. That means you're not going to have to worry about getting in or out. If the bid and ask is really wide, then you are going to have to worry about getting out. That is a real thing. We lost somebody. Who do we lose?
David had to leave.
Yeah, we lost David.
I trusted that guy. He just bounced on me like that.
Chris, if we're looking at the 80 delta, doesn't the stock actually have to move by 120% to meet that break-even example of $10? So the stock would have to move $12 because we would have extrinsic that we wouldn't have lost, right?
All right. So what was the question again?
So 80 delta
Mhm.
is going to move 80 cents for every dollar of the stock, right? So then if the stock moves $10, to me, it only moved $8.
Correct.
Right?
Your option is going to change the value by $8. Yes.
Yeah. So does that mean the stock actually has to go up by $12 for me to break even?
Oh, no, for sure not. Because like, let's use this example here, right? If you bought it for $10 and it's at the 80 delta, right? If this goes up $10 here, your option is now worth $20. So you've got basically a 100% return, give or take. No, it'd be where, what it would be, $18. So 80% return on that. I mean, you'd have an 80% return. You definitely don't need it to go any higher to make your break even. Like, and that's the point of going. In fact, all you got to do is add your extrinsic value to the strike price. That's your break even point. I mean, it's simple as that. Add your extrinsic to your strike price, and that's where you break even. That's why I try and minimize extrinsic value, right? Rather than having to buy it way out here where it costs 3 or 4 times more than what I'm paying up here in extrinsic value. Yeah, the option costs more, but the extrinsic value is significantly less. Oh yeah, good question there. All right, we'll take one more question from the chat. Oh, Nate says, this is exactly why I didn't apply for Outlier University. I cannot dedicate the time, so I'm always available. Sad but true. Chris needs to get me to financial independence, and then I'd be in this all day long. Well, dude, Nate, the great thing about YouTube, it's always available. Right? It's always available. So listen, thank you guys so much for coming to class today. Be ready. If you thought today was busy, if you thought today was hard, Thursday's going to break your brains. I'm sorry, but this is my favorite game in the world, and this is where it gets really, 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 I don't want to say it's going to get complicated, because once you understand it, it just flows off like the back of your hand. But there is a really steep learning curve, and we are right at the peak of what that learning curve is. So thank you guys for coming. Thanks you for watching this, and be sure if you want to save time, make money, start winning with less risk, what do you guys need to do?
Click over here.
Click on one of these 2 videos. Right. Exactly. Thank you guys for coming. I'll see you all next class. Talk soon.